The move already started, not the explosive one people post screenshots of, not the vertical candle that trends on social media. I'm talking about the quiet shift, the kind that doesn't look dramatic until it's too late. XRP didn't spike overnight, it stabilized. After months of volatility, the candles narrowed, the wicks shortened, the chaos faded into compression. On the surface, it looked boring, sideways, uneventful. But at 2:48 a.m., staring at the order books glowing in the dark, I noticed something that didn't fit the boredom narrative. Liquidity wasn't thin anymore. It was patient. Large bids sitting just below price. Not chasing, not flashing, just waiting. Every small dip absorbed almost instantly. No panic cascades, no emotional dumps and derivatives. Funding rates weren't overheated. Open interest wasn't euphoric. Leverage had been cleaned out months ago. This wasn't retail excitement. This was structural preparation. Meanwhile, regulatory tone had softened, not loudly, not dramatically, just enough to shift risk perception around assets like XRP and companies like Ripple Labs. The headlines weren't screaming bullish, but the positioning was. And that's when it hit me. The stampede doesn't begin when institutions announce themselves. It begins when they quietly finish accumulating. By the time 2026 predictions hit mainstream headlines, the move may already be halfway done. Let me show you what I'm seeing beneath the calm. I went back to the crash months ago, the one that flushed leverage across the board. That event wasn't random. It was cleansing. Open interest collapsed, funding flipped negative, retail confidence drained out of the market like air from a punctured tire. XRP didn't recover explosively, it rebuilt slowly. That's the key difference. Speculative pumps are loud and fast. Structural rebuilds are slow and quiet. The volatility contraction I'm seeing now reminds me of previous cycle transitions, the moment after chaos but before expansion. The red candles that once triggered panic now barely move sentiment. The market feels emotionally numb, and numb markets are dangerous because they create opportunity for disciplined capital. The reset phase removed weak hands, but it also removed noise, and without noise, positioning becomes visible. For years, the shadow of the U.S. Securities and Exchange Commission case defined XRP's risk profile. Institutions hate uncertainty, but uncertainty has been decreasing incrementally, not eliminated but clarified. Legal ambiguity doesn't disappear overnight. It fades through procedural progress, settlements, and evolving compliance frameworks. I noticed something subtle. The market's reaction to regulatory headlines has diminished. That tells me risk premium is compressing. When an asset stops reacting violently to legal updates, it means participants have priced in the worst-case scenarios. And institutions don't need perfection. They need predictability. Predictability is forming. And predictability attracts capital. I started tracking exchange balances again. Slow outflows, not dramatic, but consistent. Coins moving into cold storage suggest long-term positioning, not short-term speculation. At the same time, large wallet clusters increased holdings during periods of low volatility. That's textbook accumulation, not hype-driven buying. Strategic layering, the most important detail. These wallets weren't reacting to green candles. They were building during flat structure. That's patience. And patience usually belongs to entities with longer time horizons than retail traders scrolling on their phones. I asked myself a simple question: why would institutions care about XRP in 2026? The answer isn't speculation, it's infrastructure, cross-border settlement, liquidity provisioning, tokenization narratives, integration into regulated financial systems. Institutions look for assets that align with evolving financial rails. XRP's narrative has shifted from retail altcoin to enterprise-adjacent infrastructure. That narrative shift isn't loud yet, but it's forming, and when institutions move, they don't announce entry. They create demand quietly. The stampede isn't chaotic, it's coordinated. I monitor sentiment constantly. Right now, enthusiasm is muted. People are cautious, skeptical, traumatized by previous cycles. That's healthy, because bull markets rarely begin with full confidence. They begin when skepticism dominates and price grinds upward anyway. Retail isn't euphoric. Retail is tired. And tired markets are easier for institutions to dominate. Technically, XRP's range has tightened dramatically. Lower volatility, higher lows, resistance tested repeatedly without aggressive rejection, compression builds pressure. It's like a coiled spring. The longer it compresses without breaking down, the more explosive the eventual move. But here's the detail most traders ignore: the breakout usually begins before confirmation. Positioning starts during compression, not after expansion. By 2026, analysts will likely publish bold price targets, clean graphics, confident forecasts, institutional adoption projections wrapped in polished research notes and carefully worded optimism, but those predictions will lag reality. They always do. Because analysts don't get paid to anticipate uncertainty, they get paid to validate trends once they're visible. By the time price targets hit mainstream feeds, the structural move has already unfolded beneath the surface. The models adjust after the breakout, the narratives expand after the accumulation, the conviction arrives after the risk has already been repriced. The calm phase we're in right now is where asymmetric opportunity exists, not when volatility explodes, not when headlines scream new cycle, but when nothing feels urgent, when price moves in tight ranges, when volume dries up, when social engagement drops, when even long-term holders grow impatient. That emotional neutrality is deceptive. It feels like stagnation, but structurally it's compression, and compression is potential energy. Once the so-called institutional stampede becomes obvious, risk-reward shifts dramatically. Liquidity thickens, yes, but so does competition. Entries become crowded, pullbacks get bought aggressively, the easy positioning window closes, institutions don't wait for consensus, they build before it, retail waits for certainty, and certainty only arrives after price moves. That's the trap. The market trains participants to seek confirmation, break resistance first, show continuation first, prove strength first. Only then does confidence return. But by then, the asymmetric edge is reduced, upside still exists, but the discount is gone. Real opportunity hides in ambiguity. It hides in the quiet weeks where nothing seems to happen, in the sideways candles that bore traders into rotating capital elsewhere, in the skepticism that lingers even as structure slowly improves. By the time forecasts look bold and convincing, the early accumulation phase is complete. The truth is uncomfortable. If it feels safe, it's probably late. The market doesn't reward comfort. It rewards preparation before comfort arrives. And right now, in this calm, preparation matters more than prediction. Here's what I've learned watching markets transition. The biggest moves don't start with noise. They don't begin with viral headlines, euphoric tweets, or vertical green candles that dominate the timeline. Those are symptoms, not origins. By the time noise appears, positioning is already crowded, the foundation is already poured, the early risk has already been taken. The real moves begin in silence, in the weeks where volatility compresses so tightly it feels suffocating, in the days when price barely moves and traders lose interest, in the stretches where volume dries up and commentators shift their attention elsewhere. Silence is uncomfortable because silence feels like stagnation. When volatility compresses, most people assume nothing is happening. When sentiment dulls, they assume conviction is dying. When headlines fade, they assume relevance is fading with them. But that's often when smart money builds, not aggressively, not recklessly, methodically. They layer bids, they test liquidity, they accumulate without disturbing structure. They prefer boredom because boredom keeps competition low. It keeps price reasonable. It keeps retail distracted. If XRP truly enters an institutional phase by 2026, the foundation is being laid now, not later. Institutions don't arrive at the top of parabolic moves. They construct exposure during uncertainty. They build during compression. They position when risk is misunderstood and narratives are muted. By the time the institutional adoption headlines dominate financial media, the allocation decisions will already have been made. And here's the warning. If you wait for confirmation from the crowd, you'll enter with the crowd. You'll feel safer, but you'll pay more. Your conviction will be validated, but your risk reward will be diminished. If you study structure during calm, higher lows forming quietly, supply thinning above resistance, sentiment hovering near indifference, you position before the stampede. The calm isn't weakness, it's preparation. It's the market redistributing supply from impatient hands to patient ones. It's volatility compressing before expansion. It's a coiled spring tightening in plain sight. And by the time the stampede is visible, by the time analysts publish aggressive targets, by the time breakouts are obvious and narratives are confident, the gates will already be closed because the opportunity wasn't in the excitement, it was in the silence before it.